What is going on, guys? Welcome back to the MG YouTube channel. I'm Matt here, CEO of Leon Lee Properties and an investor in Tesla, as well as other stocks and stuff like that as well. But yeah, I just wanted to shoot a video with you guys today and talk about some different like investment things and like the diversification of investments and the diversification of revenue. So you hear a lot of people. By the way, I'm gonna shoot this whole video while I'm putting this outlet cover on, and I'm gonna try to end this video when I'm done putting this outlet cover on as my timer to get done with this video. So I'm actually here at one of our investment properties right now, and yeah, doing some renovation things. But this property is actually pretty close to being ready to be listed. This is actually one of our biggest and nicest investment properties so far. A lot of the other properties have just been kind of like lower initial investments, lower starter income properties. But, you know, I also own, Elite Automation, which is obviously not obviously, but it's an automation company where we build and design, manufacturing equipment like robotics and conveyors and stuff like that. And somebody may say, well, why would you have like a business that does that and then also start another business that does, things with properties? And honestly, I've shifted much harder into properties over the past year or two, where we've scaled like way more on properties than, well, I don't want to say like automation, but we've scaled way more on properties from like, I don't know what it was, like 4 years ago, like pretty much doing like, I think we launched our first property 4 years ago, and then we launched like another property a year after that, and then we launched like, I think another property the year after that, and bought a house personally. And then like this past year, we bought like 6 houses. So it's been like a huge expansion over the course of this last year or whatever. So, why have I decided to diversify my revenue? Okay, so have you ever heard of diversification of investments? The reason for the diversification of investments is to mitigate risk, right? You might have some bet or some investment that is essentially going to have potentially great returns. Now the problem is if you put all your eggs in one basket and that investment doesn't work out and potentially goes down in value, and or you lose all your money because you follow it all the way down to the end. Honestly, I'm a follow it down to the end type of investor unless I foresee something that is like a fundamental issue on why I won't follow that investment down, right? Like if I'm just noticing that, like, I don't know, maybe their revenues just keep sinking or something like that, or their debt keeps climbing or whatever, then, I'll get out of it because I see the risk prior to the end of the investment. So basically diversify your investments to then have other potential investments that could also have the same results. So let's say, for instance, if you have a total of 10 investments, let's say, for instance, 2 of them don't move hardly at all. They stay about the same value you bought them at. Maybe one of them completely goes bankrupt, and then another one of them just kind of goes down in value just a little bit. Okay. And then between that, all of your other 6 stocks go up in value, right? And maybe 1 or 2 of those do 10x return. And so that creates like a balance of, you have some of these ones that did 10x return, you have some of these ones that went bankrupt, you have some of these ones that kind of just broke even. And so it balances out in a way that it mitigates your risk, where you're pretty much guaranteed a return, right? As long as your total portfolio of investments are good investments that are either, that are definitely following fundamentals, but that are also following not just fundamentals, but what's the other thing? Futuristics. So like, I'm a big futuristic investor, so that's one of my investment philosophies. You might have other investment philosophies that you want to follow, but futuristic things is a big part of my investment strategy, right? So I'm investing in AI, I'm investing in humanoid robots, I'm investing in, um, let's see, now the new one is space. I just made a whole long, like 30-minute video on that one about investing in AI space, or not in AI space, investing in space. And AI in space will be one of the big ones, but and one of the first ones. But yeah. So now I kind of want to break down. I don't know. I want to break down, why we're doing the properties and why, diversification of revenue is very important. So you'll hear a lot of people, or a lot of people will try to start out by doing side jobs, by creating passive income. Maybe it's through rental properties, maybe it's through, it could be anything, right? Any way that you can, either make side job money, aka extra money outside of your normal job, even if it's doing the same task, right? It's just outside your 9 to 5 job, so that way you get, you just make more money on a weekly basis. That's also a diversification of revenue, right? Because now you're not just relying on your 9 to 5 money, you're relying on your, or you're not relying on, well, you're probably still relying on your 9 to 5 money, but you also have an alternative source of money coming from the side, okay? And this is where passive investments become very powerful, because they'll take less of your time, like us doing these property things. They take less of our time. We have to put in initial work to get them listed and do renovations that we do to the properties, and so there's that initial work that we put in, and we actually don't get anything out of it because it's all just putting into it. However, on the flip side, we just pull out of it, and we get to pull out for years and years and years. And occasionally things will come up, maybe a furnace quit working or something like that. And we've been lucky enough that everything that we've had happen to us, it's been just like a service technician call, and I think the most we spent on like a heat and AC guy is like $600-700 or something like that. Which is, not terrible. But yeah, diversification. Okay, so your different revenue sources create a diversification, right? And so going into like the property thing and passive investments. Passive investments don't cost you time. So let's say, for instance, if you're spending your extra 9 to 5 time, I'll give you 2 different scenarios. You're spending your extra 9 to 5 time, either, let's say you're an electrician, and so you go do side jobs and you do electrical work. The flip side to that is you acquire a property and you rewire that entire house, right? So one of them, you make money on the weekend and you took that cash and now you have money in your pocket. The other one of them is you go work for a weekend, you make no cash on hand. However, you just added equity to a property that is going to make it more appealing for either somebody to rent it, to buy it, or for you to go and refi it, right? And so that's actually one thing that we do to all our properties. We go through and we refresh the electrical, because it's like a lower cost thing to do, and it adds a lot of value to the house. It adds safety to the house by just having fresher outlets. Like when we bought this house, there was a few outlets in here that were burnt out. But okay, so going back into that. So the two of them are very different, because one of them you pull money out one time, and sometimes you need cash right now. Sometimes you need to do the side jobs to get to the point where you can afford to buy the property, so that you can then do that second option, which is do the renovations and be able to have more equity, more long-term revenue and cash flow, into the future. By the way, I'm done with the outlet. This video is going to go longer than me doing this outlet. I kind of figured it would, because they always do. By the way, also, whenever I do these outlets, I always put the screws in the same direction, and I just feel like it looks better. I like that uniformity. I have a though. This screw's not sitting in here well. Get in there, dude. so you create these diversifications in your, or you have these different ways that you can kind of generate income. Okay, so now the next reason, or the next thing is why would you diversify your revenue? Okay, because one is an investment, right? You could either choose to invest in properties or you could choose to invest in stocks. And I really have a roadmap. I'll just mention that roadmap real quick, and I can make another video in the future if y'all are interested. But the simple roadmap that I would put in place for almost anybody is work your 9-to-5 job, put your money in the stock market, work your side jobs, put your money into the stock market. This is not investment advice for legal purposes and all that good stuff, liability purposes. You got to make your own financial decisions. But take all extra cash that you can make, put it into the stock market. If you want to do some small hedge against that and you think you'll cash out refi on your property at some point in time, like in the next couple of years, you can go ahead and start making some additional mortgage payments to your house. Now, I think that's not a good source of money, but it's better than putting money in savings. And only do that if you already think you're going to cash out refi to maybe pull some equity out of your property. Maybe you bought it and you did some renovations and all that good stuff. Now, the next thing is, after you have that stock market money, you can either continue to do that stock market money thing, or you can take that money out, put it into another investment like properties, you know. So you basically, during the time period of building up enough for a down payment, you have that money still growing in like a stock market account. Boom, you take it out, you buy a property, maybe you still have some money in the stock market, maybe you don't, but that property starts generating you money, you let that money and all the other money that you're doing go back to the stock market, okay? And then you allow that to basically keep occurring. You keep stacking up money again, and you keep letting the stock market do its thing over here, and also that new property's feeding into it. Once you reach enough money again, do that same thing, rinse and repeat. Also, that first property that you got, a major way to scale. This is major. This will save years and years of your life. It's a cash out refi on that property. Okay. By the way, this is why I'm not supposed to be going into this video. I'm trying to make this shorter, or make this part of this video really short. But I'll just make a full video on that if y'all are interested on like how to kind of scale your money. But I don't want to leave this. The refi is one of the biggest ways to scale on a property, and buying a property that you can refi on and know that you can refi on and pull cash out of is the way to go to continue scaling, right? This is the difference between you not being able to invest again for 5 years or you being able to invest again in 6 months. That's one of the biggest ways that I'm generating wealth right now is like wish-washing my money. That's how I call it. I wish-wash my money. I put my money into properties. Some properties I let the money sit. Some properties I take that money out and I put it in the stock market. Okay, so perfect example, this house here that we're sitting in. They wanted $280 for the house. In the end, we ended up paying $240 for the house. We probably put $40K in renovations, and we're gonna be able to pull $100K out of this property cash. Okay, so you can see that we're gonna pull an additional $20,000 from what we have in this property. And I just gave you rough numbers. I don't even think we spent $40,000 on this house. I think it's, that's probably, if it is $40,000, that's including appliances and everything, which are not necessarily an asset of the house. We can always take those with us. But again, we're still not only are we getting $20,000 additionally back, but we're getting our initial money back. And in this cash out refi may not even be a bad gig if you're getting, not even all your money back. If you're able to do that same scenario where you put 80 in it and then you pull like another you pull like 60 out, right? You might still have 20 still wrapped up in the property, but now you have a whole property and you only have 20 wrapped up into it. You take that 60 and you can pay back down the credit card debts or whatever you need to cash flow to do this property, and then boom, put it back to the stock market. Or you can not pay off the credit cards and you really want to pay down credit cards unless they're like 0% interest. If there's 0% interest, I'd ride those out as long as you can, and like put the money in the stock market and then just like pull it out like whenever it's time to make that final payment. But don't miss it, because deferred interest can smack you in the end if you don't get it paid off in time. Now we've reached a point of so much volume of business that we're doing that like I don't even have to worry about deferred interest, because I have deferred interests that are like 24 months out, and I barely get them. So some of them, they only last like a couple of months before I reflip them. So like I'm constantly not paying interest on all those credit purchases there. But that's kind of a side tangent from this video. So the diversification of the revenue streams is basically so that, you know, so that you can divide your risk, so you can divide and create different cash flow intervals. And see, like a lot of this stuff, I can just keep going deep into all these things, like cash flow intervals. What does that mean? Cash flow intervals means, like, let's say for instance my properties company, I might get 2, 3, 4 payments in a week, right? From somebody renting our property out. We do short term rental. So we might get 3, 4, 5, and the number could be more than that in a week. Payments that come to us, right? Now my automation company, there's sometimes that company doesn't get a payment for 2 months. So that's the cash flow diversification, right? This thing over here, might cash flow a couple times a year. Now the cash flow of that property is much larger. The volume's low, the amount is large, right? So a lot of our transactions over there are hundreds of thousands of dollars at a time, versus over in the properties, the cash flows on those might be anywhere from $75 to multi-$1,000s. I mean, there's sometimes they can be up to tens of thousands of dollars, if like payments align correctly and stuff like that, in a particular day or a week. And also too, then we run into instances where somebody on the property side of things keeps extending their stay. Like they don't have a lot of money, maybe they're working, and then like it's kind of a funny scenario. People are like doing like night by night almost, and with that night by night, basically they're giving us a payment every single day. Boom, 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 boom. So we have somebody staying in one of our properties right now where I think we've gotten a daily payment for over the past week. Small amount, like $75 or something like that. But the interval of that payment it hits so quickly. And that's also a big thing on like what service that you're utilizing. So like with that's like Airbnb, but you might have another service, and or Airbnb could change their policy in the future where they say, you know what, we're not going to do a day-by-day payment. We're only going to do, like, we're only going to pay you out weekly, or we're only going to pay you out monthly, and that'll really impact that cash flow of that business. So they are dictating that. And then also you have different platforms where maybe a different platform like VRBO or something like that might have a different payout schedule than what the payout schedule of Airbnb is. Perfect example is like we have a Turo business where we rent out vehicles, and so with that one, they don't pay you until the vehicle comes back, whereas Airbnb pays you when the guest comes. So you're always behind on the cash flow. Somebody rents a vehicle out for like a month, you don't get the pay. They've rented the vehicle out, they have the vehicle, but they don't even pay you for a month. Whereas like with Airbnb, it's the opposite. They pay you up front, which I like Airbnb's better. I like everything about Airbnb better than Turo. A whole nother video, but. It's just a better way for them to take care of their vendors, their hosts, and stuff like that. They're receiving the money from the customer. There's no reason that they can't give it to the vendor. I mean, there is a reason. The reason is that they're holding on to that cash and they're making money off of interest. That's how businesses do it. Like that Turo probably makes so much money off of interest because they're holding money for 7 days. And you got to think about it. Between all the hosts that they have, they might be holding, $100 million. So if you're holding $100 million for 7 days and you're on whatever percent interest, they're making millions of dollars a year in interest by holding somebody's money. That's how money starts to work whenever you're really at big scale. It also is another way that you can kind of grow your money, like things like Robinhood. If you have Robinhood Gold, they'll give you you can get like, I think it's up to like 5% interest right now for your money just sitting there. So even if you don't have that money invested, which I love that, because sometimes I have money sitting on the sidelines and I'm like, I don't see the best opportunity to buy in at, but my money's still sitting there gaining 5% interest, which is still better than nothing. Still better than just sitting as cash. And I'm actually kind of looking to like, how can I take my properties and run it through that same like account, so that way basically all my incoming Airbnb payments run through that 5% interest account, and then so like as it sits, for example, like right now we want our account to have $20,000 in it at all time because of cash flow, right? That's going to manage our expenses for a month and make sure that we have enough money to cover all of our expenses. But that's just $20,000 just sitting there. That could be making interest. If you look at like what $20,000 is 5% interest for a year, I mean it's nothing to sneeze at. What would that be? Like 10,000 would be, I mean it's a couple $100 maybe. You know, it's not a lot, but it's still a couple $100. 5%, is that right? I think it might be $1,000. At $20,000, it'd be like $1,000 a year, which is not a huge amount, right? But this is how like you take 1,000 a year here, 1,000 a year there, 1,000 a year there, and this is also where the diversification of revenues come from. Is because now you're making 1,000. Even if you add one more 1,000 a year from this, from that, from this, next thing you know, you gave yourself a raise of 5,000 more a year, 10,000 more a year, 20,000 more a year. You know, those numbers start to grow as you're able to do more things. And that's really where things start to become powerful. You hear things like compound interest. Well, there's compound revenue streams, right? Compound businesses. You know, like everything compounds. The amount of properties that we're getting will compound. The amount of business that our other company does will compound. The the amount of interest that we're making on things will compound. And all these things, and then we'll launch new businesses off of these businesses because we have extra cash flow to the side, and now we compounded in the number of businesses that we're starting and acquiring and things like that. And so the market's about to open, guys. I'm about to have to jump off here and see what's up with the stock market this morning. Yeah, let me know if this went deep enough into the diversification of revenue. We had a lot of other side steps in this video. I think they're all super valuable. It's sometimes a little bit hard for me to stay on topic because like I just think of so many valuable aspects that like people just really need to know, and if they don't know these things, then like they don't start building the mindset, right? Like building the mindset of these things, you got to practice it, you got to do it, you got to you got to watch thousands of these videos, my videos, other people's videos like mine. You know, that's where I knew I was different and knew that I could do things different than other people were doing, is because I was willing to invest my time in watching videos like this and just growing and growing and growing myself mentally and start understanding like what people are talking about. And even today, my mentality changes. You know, I've been watching these videos for 15 something years, and my mentality has just shifted. I mean, even like again these last couple of years. And I think your mind and mentality will always shift. And that's why somebody who's like 45 years old, especially who pours into themselves like this, is really so sharp and so wise and able to do so much. And those years really do compound. You learn so many more things, and your brain rewires itself to different ideas and thoughts and premises of things that just help you overall grow and learn and see opportunities and yeah, it just becomes really, really powerful. Diversification of revenue. Yeah, so again, you got your cash flows. You got your cash flows at different intervals between different businesses whenever you have different revenue streams. And I kind of took that to businesses immediately. Again, it could be side money. It could be that you bought a property and now that property is giving you money and you're doing side work and you have a 9-to-5 job. You know, and then at some point in time, you might decide to trade off the 9-to-5 job. One thing you might decide is to trade off the 9-to-5 job for doing whatever your side job is full time, or starting that out to be its own business. You know, maybe like again, I used the example of an electrician. Maybe you start your own electrical company versus just doing side work as an electrician. And then maybe you start hiring employees, and then that has a compounding effect. But yeah, there's all kinds of different ways to start capturing different revenue sources. But you gotta start working towards different things, right? You gotta again start doing side work. And whether it's in your profession or not in your profession. I like in your profession, especially if you have a skilled trade. Why? Because what else are you gonna do that you're gonna go out and make the same amount of money that you are making in your profession? Like if you're an electrician, you should be able to go make like $65 an hour or something like that on the side as cash almost. Or even if it's $55 an hour, but it's cash versus $65 an hour, not cash. So those are all things to think about. Also, I like, and you should also want your money to be documented and not be cash. You really don't want paid in cash. Now you can, but the issue with cash is since it's undocumented, it's going to prevent you for other opportunities. Like let's say for example, I made $100,000 in cash, right? I can't go to the bank and get a loan against that $100,000 cash because that bank never seen that, and they don't have a way to verify that cash. Also, the government can come and get you, which would not be good. But the more money you have documented on paper and that's on your tax returns, the more money you make, right? The more money people are willing to lend you, the more money, you're able to qualify for and builds your credit, because like really your credit and everything really, I think they know your tax returns. They may not publicly mention it, but I'm pretty sure like your credit score also has an association with how much money you've actually made the year before. But yeah, again, let me know what you guys think of this video. Make sure you subscribe for more content like this. This is like an interesting thing, like just shooting the video here at one of our properties. I kind of want to just do more like kind of working and talking to you guys, kind of really give you guys a bit of the behind the scenes of what we have going on, and really kind of get a vibe on the day to day. Oh, and one other thing that I wanted to add was, this is a very funny thing about myself. There's days, when I was talking about trading off like the 9-to-5 job to make something your full-time job, there's days where like things are kind of slow within all my companies, and I'm like, I'd like to have a 9-to-5 job right now, because that way I can, make some more cash, right? Because that's just direct cash. One thing about 9-to-5 money is that's cash in your pocket. You've already paid taxes against that. That's one big thing about once you become a business owner is like the cash that's in your pocket doesn't mean that's your cash, right? People just don't understand this. People because this comes with the mentality. People think like, oh, you're rich, blah blah blah. I might be cash wealthy or whatever, but whenever you have so many expenses and whenever you have to pay taxes against this cash that's already came in, and if you haven't withheld any money for taxes and stuff like that, now all this cash you have sitting here, it probably didn't go toward taxes or something. But yeah, this is something to think about, like, as you're transitioning from like a 9-to-5 job to a non-9-to-5 job, is again like that 9-to-5 money is cash in your pocket, and you can take that, reinvest it, you can do whatever you want with that money. Whereas like when you become a business owner, your cash flows change. Again, like when you're a 9-to-5 employee, you get paid every week, every 2 weeks, guaranteed. Boom, every Friday. Boom, 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 boom. We have all our properties and stuff like that. We also go through gaps where maybe we don't make any money for 2 weeks because we already got a bunch of books, whatever. I'm not gonna get through all the details, but we may not get a payment for 2 weeks, 3 weeks, right? And now that we're getting more properties, that's going to change because there's, again, diversification in the number of properties as well, right? More properties you get, the more diversification you get in your cash flows and things like that, right? But you also have harder lows and harder highs too. Okay, I'm going to quit ranting. Subscribe if you want to watch more content like this, and I'll catch you on the next one. Peace.